The U.S. housing market is navigating a complex landscape, to say the least, between shifting interest rates from the Fed to changes in buyer behavior. Francis Katzen joins us now. Francis is managing director at Douglas Elliman to talk all about what these changes mean for both buyers and sellers. Francis, welcome. Nice to have you here today.
Thanks, JD. Nice to be back.
How would you describe or kind of diagnose the overall state of the U.S. housing market here in Q4?
We're seeing high prices and an ongoing affordability challenge. The inventory has leveled out a little bit more, but it's still well below historical norms. I think what we're seeing is that it's keeping prices elevated. Home values are continuing to rise. I think that it's a slower pace than in recent years. And I think people are a little bit sort of standoffish at this quarter as we enter into an election. And I think even with the Fed reducing 0.25% a few days ago, I definitely feel that's a welcome reprieve amongst all of the frothiness that I see playing out.
How many more Fed cuts do you need for that reprieve to be taken even further? There's a lot of people eyeing the long end of that yield curve, and they say it's all well and good for the FOMC to control the short end, but we really want to see relief on the long end, specifically for the mortgage side of the conversation. Is it a number of rate cuts for you? Is it amount of time for the dust to settle? What's the relationship you're looking for?
Think that we need to sort of level out the fact that we still have this affordability disconnect, right? We've got people between 4 to 5 million that are really trying, actually 2 to 5 million trying to get in. And it's got to make sense on the rates. So the rates really are never going to be what they were in the 2s to 3s. So I think we have to wipe our tears on that and get used to the 4.8 to 5.5%. And I think the Fed needs to do a few more adjustments. But it's really hard if they're flying blind. They don't have the data that they once did. So it's also compounded by that, I think.
Yeah, of course, given the ongoing government shutdown, we had one CPI print. Maybe you'd argue they've got, ADP private payroll to go off of, a little bit of numbers here and there, but certainly not the full suite of data that the data dependent Fed likes. I wonder what you're seeing with regards to the luxury real estate market. How does it compare or contrast really to the broader market?
We are seeing at the upper echelon some of the most staggering trades that you could imagine. I think the first quarter really proved its muscle. I think we saw a real quietening in the second quarter. And I think the rest of the market below luxury, 4 million and below, have been the most frothy and stagnant out of all of them. But we have seen inventory levels sort of climb up a little bit, sort of proving its worth, but it has elevated the pricing still because of that shortening of inventory. There's not that much. It's an interesting time. It's very disconnected to the ultra luxury, to the mainstream market.
Yeah, of course, here it's a bit easier for myself to wrap my head around the state of real estate right here in New York City. It's a city with its own unique challenges. But I wonder, are you seeing comparable pricing pressures or maybe opportunities across markets? Are there particular parts of the country that you think might actually be faring a little bit better than others?
Well, New York City is its own ecosystem. It is its own comp, if you will. We are finding that the ultra luxury is taking action. We've got 60% of our deals over 3 million all cash. We're finding people are getting in because there's opportunistic pricing. It's still a buyer's negotiation pool here. The ultra luxury is not dependent on mortgages, so they're taking full opportunity to buy against the grain. It's that sort of mid-tier market that's down, but it's still up against last year by 5.8%.
Francis, not to get too needlessly into the politics about this, but you and I are having this conversation, as you said, ahead of a big mayoral election here in New York City next week. Housing affordability front and center, especially for some of the candidates, more so than others. People may look at that and say, okay, if there is a new mayor who has talked about certain things, will we immediately start to see a little bit of alleviation here in New York City? And kind of what do you make of how that's been politically postured, and what does that mean, if anything, for the unique ecosystem of NYC, like you said?
That's a very broad question to get into. But with that in mind, depending on who is elected, will determine what happens to most of our current legislation as it relates to taxation, as it relates to rent, as it relates to development and that maintaining that drive. I think that certain policies will deter investment. New York is based as a capitalistic investment hub for many, and it's going to quell a lot of that. I also think you're going to find that people are uncomfortable with the taxation that it may actually play into effect, and obviously the rent freeze, which means the landlord and the procuring parties are going to carry that burden. And ultimately, will that maintain the quality and caliber of what's being offered based on the cost adjustment?
Are you advising your clients to navigate the current period we are in where there are expectations of further interest rate cuts, but they're certainly not guaranteed to happen?
Think people still need shelter, and I think people still want to diversify assets. And I do think that when you have movements like this, they open up uh, capitulated pricing. And I think that's where the value is. And it's a long term hold, real estate by nature.
Francis, while I still have you, as we take a look ahead here to 2026, are there key trends or opportunities you'll be looking for that you think will more clearly define the state of the housing market than others?
I think real estate is a patient process. And I think we're not in a state of panic, but rather a shifting of what's going to create the most effective opening for value. I think that the city has a resilience unlike any other, and as its own ecosystem, will find its footing pretty quickly.
Francis Katzen is the managing director at Douglas Elliman, helping us to make heads and tails of a very complex but very important state of the housing market today. Francis, thank you. It's nice to have
Thanks
you.
for having me. Nice to be here.